Hey everybody, Smart Silver Stacker here. I'm recording this video early Friday morning, late Thursday night. It's about 1 a.m. right now, and it looks like the price of silver is getting smacked down pretty nicely here in the overnight trading, down over 2% under the $27 level, and I suspect that this has something to do with the spike in U.S. Treasury yields that we saw earlier today. I mentioned in a video just a couple days ago that this was something we should keep an eye on, and we were at risk of a big move up. And it looks like we got one today. The 10-year yield spiking to over 1.5. I think at the highest peak of trading today, it was up almost 10% in one day, which is a huge move for bonds. I think that a lot of investors view this as negative for precious metals. The idea being that, interest rates are moving up, easy money is on its way out. I just don't think that's accurate. I think, in fact, this is going to be bullish for the precious metals in the long term, primarily because of what is coming in terms of a response from the Fed and central banks to try to keep rates down. So Jerome Powell basically told us just a couple days ago that he was okay letting inflation creep up as long as rates were kept down, and his justification for this is trying to help improve the employment situation here in the U.S. economy. I think that the real reason for it has something more to do with the fact that we have unsustainable levels of debt in this country, and any significant move up in interest rates will bring the whole charade to an end, and the whole house of cards will come collapsing in. But according to Jerome Powell, it's because of unemployment, and there is a big unemployment problem right now. That's for sure. We do have very high unemployment levels. We basically, at this point, have a zombie economy that's being kept moving forward by endless rounds of stimulus, and that's what we're going to get more of. The Fed was already buying at least $120 billion a month in bonds, and we saw this spike today despite that. So I think that what we're going to end up seeing is the Fed is just going to have to buy basically as many bonds as they have to drive down the interest rates and to keep them low. And, it's basically just a supply and demand problem. There are way more bonds out there than there are buyers who are interested in low-yielding U.S. debt. And why would you be interested in a 10-year note that's yielding 1.5% when the inflation rate, the real inflation rate, is much higher than that? People aren't willing to take such low yields on debt that's denominated in a depreciating currency like the dollar. The ironic thing is that the Fed's response to this is actually going to make the problem worse. We're going to get more inflation because they're going to have to just fire up the printing presses to buy U.S. government debt to keep these yields down. Now, one interesting thing, there's an article over on Zero Hedge. It's Treasury yields explode after catastrophic tailing 7-year auction. But the really interesting chart, I think, from this article is of the auction indirect. So those are basically foreign buyers of treasuries, and you can see their interest fell way, way down today. And I expect that to be a trend that we see as well as countries around the world stop investing in U.S. dollar denominated debt. And they're going to stop taking these IOUs in exchange for their goods and services. And that's really going to be the end game when that finally happens. So I don't know if that's right around the corner or if it's somewhere down the road. All of the treasuries that are held in reserve by foreign countries, when they start to really become concerned about the value of the dollar and they start trying to unload that debt, it's going to be an even bigger problem as far as the yields go, because the supply side of the bonds, there's just going to be more supply of bonds than there is demand, and that is going to drive interest rates up even further, unless, of course, we get some kind of intervention from the Fed. Now, a term you might start to hear more about is yield curve control, and I'm just going to go ahead and read the definition of this from Investopedia for you. Yield curve control involves targeting a longer-term interest rate by a central bank, then buying or selling as many bonds as necessary to hit that rate target. This approach is dramatically different from the Federal Reserve's typical way of managing U.S. economic growth and inflation, which is by setting a key short-term interest rate, the federal funds rate. Advocates of yield curve control, also called YCC, argue that as short-term interest rates approach zero, keeping longer-term rates down may become an increasingly more effective policy alternative for stimulating the economy. Also, this approach could help prevent a recession or lessen the impact of a downturn. Richard Clarida and Lael Brainard, current members of the Board of Governors at the Fed, as well as former Fed chairs Ben Bernanke and Janet Yellen, have said that the Fed should consider using yield curve control. Jerome Powell, the current Fed chairman, also has said that he is potentially open to this as a policy option. Well, we've got Janet Yellen as the Secretary of Treasury, and Jerome Powell is in there as the chairman, and they're both in favor of this. So I think this may be one of the forms of intervention that we see in the bond market going forward. Here's the key takeaways. Yield curve control by the Fed would target specific long-term rates levels. It sharply differs from quantitative easing in its approach. YCC may be needed for economic stimulus as short-term rates near zero. Former Fed chairs Bernanke and Yellen support the use of YCC. And here's how YCC and QE differ. Through quantitative easing designed to combat the 2008 financial crisis and the Great Recession, the Fed injected liquidity into the financial system through massive purchases of bonds on the open market. This bid up the prices of bonds, thus reducing longer-term interest rates and borrowing costs. However, during the financial crisis, the Fed was not seeking to set a specific long-term interest rate. By contrast, under yield curve control, the Fed would set a specific long-term interest rate target and buy as many bonds as necessary to achieve it. YCC would set a specific price for the bonds in terms of their yield. Okay, so, and this goes on, it'll tell you some examples of yield curve control programs. I'm not sure exactly what we're going to see from the Fed going forward, whether it will just be something like quantitative easing where they just go into the market and buy a bunch of bonds to try to drive the price down, or if they're going to pick a specific treasury and try to just pin the rate and they'll buy as many bonds as necessary. But at the end of the day, all they can really do is buy bonds. How they do it, I don't think is materially too important because it's all just they're tinkering and screwing around in the market. I mean, what we really should have is a interest rate that is set by the marketplace. That would be the healthy thing for the economy. But the Fed is intent on manipulating things and trying to pull levers and keep the economy going the way that they want it to without allowing any of the natural corrections or recessions that we probably need to call out some of the zombie companies and all of the malinvestment that's occurred over the past 2 decades of easy monetary policy. I suspect that we're just going to continue to see stuff like yield curve control or quantitative easing. So if we see rates continue to move up, expect to see a lot more intervention. And here's an article from Bloomberg that just came out late Thursday night. Central banks fight back against bond rout, calming investors. And it just goes on to say that central banks already are going in and buying bonds. The Reserve Bank of Australia waded in with more than $2 billion of unscheduled purchases, while Korea announced buying plans for the next month. So already central banks around the world are beginning to respond with intervention and purchases. And don't expect the Fed to sit out the creation of money and the purchasing of debt. They're definitely going to be leading the way, I'm sure. And while I do think that investors right now are kind of getting this wrong with gold and silver, with the prices falling with the news of rising interest rates, we are beginning to see the effects of a lot of the inflation that's occurred in prices of other commodities. So here's an article from mining.com, and the title is Copper Prices Soar to 10-Year Highs. And that's because the price of copper just went up to $4.23 a pound, which is the highest in 10 years. And I think it's just about 20 cents off of the all-time high for the price of copper. And you can see this across the board. Industrial commodities, food, soybeans, corn, all that stuff. All of that is moving up in a big way. The oil price continues to move higher. And I think it's just a matter of time before it dawns on investors just exactly what's going to happen here in terms of money creation and intervention by the Fed. And when that happens, the price of silver and gold are not going to be falling like this. They're going to be moving up in a big way. So, of course, this isn't financial advice. I'm not telling you what to invest in. I'm just kind of telling you how I see things. But if we get a big correction here, I hope it's a steep one because it will be a great buying opportunity for physical metal. And that's what I will probably be doing. I'm going to sit out for just a moment here, and if we get a big pullback, I will definitely be adding to the stack. I think that that's what investors eventually are going to come to the realization that they need to do to protect their wealth and their purchasing power as the Fed continues to create money out of nowhere. But let me know what you think, guys. Is rising interest rates bullish for the price of silver and precious metals? Or is it an ominous sign? Is this pullback just the beginning of a bear market? Who knows? But I think that we're going to be moving up, even if we have some short moves down, and I'll be viewing those as a buying opportunity, and I'll be buying the dip, or stacking the dip, as I like to say. Thanks for watching, everybody. Leave me a comment below. Let me know what you think. I'll catch you next time. Smart Silver Stacker out.